If you're talking about properties that need management and stuff like that, what length of time can you go without those being managed? And so you need a plan for incapacity. You need a smooth and easy and tax efficient transfer at death.
Hey, Rent to Retires, it's Adam Schroeder here with another episode, joined as usual by the founder and CEO of Rent to Retirement, Zach Lemaster. And we are joined today by John Ross. He is the founder of a real estate or a boutique estate planning and asset protection law firm. That is Ross Shoalmire, P.L.L.C. And we're going to talk about some protection today that's not exactly what you think of when you think of real estate. John, welcome to the show.
Yeah, glad to be here, guys.
Absolutely. So tell us a little bit about your background so we can know kind of where you came from, kind of where did you come from? What did you, I guess, major in terms of this? Like, how did you get into the field that you're in today?
Yeah. So just real brief, I got out of the Marines. I was in the infantry in the Marines for a number of years, got out, went back to college. Weirdly enough, kind of fell in love with accounting and in particular tax. Everybody I knew kind of thought I was a little crazy. And while I was studying tax accounting, I remember one of my professors said, well, once you really get up into the fancy stuff, the estate tax and gift tax and all of that, that's really the purview of tax attorneys. And I thought, well, that's stupid. I don't want to share my fees with anybody else. So I got the bright idea to go to law school, went to law school with pretty much the sole idea of becoming a tax attorney. So did that, went to law school, got out, passed the bar exam, got into practice, and really started focusing on the interplay between estate planning, taxation, business structures, and how all of these sort of things come together. And then that folds into various forms of asset protection and all of that sort of stuff. So yeah, that's the kind of the short and skinny of it.
Uh-oh, you started dropping tax things. I saw Zach's ears perk up. And that one.
This is something, John, that I think would be very interesting. Yes, for me personally. I mean, I love doing the podcast too, because a lot of it is self-serving, right? Adam and I get to ask questions that we can apply to our own real estate investing career path, but of course we want to serve our community and our listeners as well. But this is very interesting to hear about your background, because you have both an accounting background and a law background.
Right.
And then you get to marry the two, right? So I always talk with people about being a successful business owner, an entrepreneur, which you are when you're building a real estate portfolio, like it or not. I mean, you need to be aware of those things. You're building a business, but it's all about, to be successful long-term, you add the right people to your network, right? And make sure you're getting the right tax and right legal advice. And often I've found in my career path that doesn't always agree, right? Sometimes you can have an attorney that's telling you one thing and your accountant telling you another thing. And it's like, well, we need to get everyone on the same page to understand our goals moving forward with running our business, with investing in real estate. And it's great that you have both those backgrounds, so you could probably share your philosophy on, weighing in both those areas.
Yeah. And I will say, generally, I would say most of the attorneys out there know jack about taxation. They don't even know how to do the books for their own firm. They get somebody else to do that. Right. And that's fine. That's not their expertise. But so often they may be giving business advice, but have no real concept of the tax consequences of that business advice or that estate planning advice. And then on the flip side, I find CPAs to be historical thinkers, right? So what they want to do is they want to see what you've already done and then report that appropriately. But so often they're not prospective thinkers. They're not, well, what could you do today that would change what would happen in the future? I also typically find CPAs to be somewhat risk averse, which you want your CPA to be risk averse. That's their job, right? But when it comes to taxation, it's a blurry area. And so you need to be able to at least know where the boundaries are And then you can take your comfort level to whatever boundary you're willing to push. And that's not necessarily, that's more of a lawyer attitude than it is a CPA attitude. And so, yeah, having a blend of the two is a bit unique, but I think it does give me a great perspective on looking at somebody's stuff and saying, okay, what do we need to do? What do we need to think about?
That is a exceptional point that I don't think anyone has ever mentioned about the way to approach your tax strategy. And it's not necessarily a black and white, type of scenario. I think a lot of people, when they look at taxes, like, oh, I can do this, I can't do this. And that's it, right? And often that is coming from their CPA, who is, we like to refer to CPAs as defensive thinkers, right? They're a necessary person, but you need to have your offense as well as your defense. And that's where the planning or the tax strategy comes into play. And certainly there's a legal aspect that you need to be aware of. But as business owners and real estate investors, every choice we make has a level of risk threshold, right? There needs to be an evaluation done on, like, where do I buy and how do you structure the tax scenario around there? And I love that you brought up the fact that it's not black and white, because it often is not. And it's just, if you're just relying, first of all, you're filing your own taxes, don't do that. So you need to have someone do it for you. But secondly, if you're just relying on your CPA, you maybe, and sure, if you have one property and you're like just filing for that year, great, that serves that place, serves that need. But then how do you strategically plan for the future to be able to take the advantage of all the tax benefits? And this is a big thing that you need to be aware of. So I'm glad that you brought that up.
Yeah, you talk about, like, buying a property, and I mean, one of the first examples that would come to my mind, you're saying, okay, well, I'm going to buy this property, and so you buy the property, and then you get to the end of the year, and you tell your CPA, you say, hey, I bought this property, and they say, okay, well, great, well, that's you paid X, and so it's long-term depreciation, and we can, we'll take a depreciation of 1/30 of the value of the property, and we'll just keep doing that over time. Whereas, and so that's the retrospective attitude, right? Where the prospective attitude would have been, okay, well, hey, when you buy that property, maybe we should do a cost segregation analysis. And we think about, okay, well, I buy a house, right? Well, okay, that's a house, and that's a long-term depreciable asset. So I'm going to depreciate the value of this home over a long period of time, right? But if you look around in whatever room, as the listener of the show right now, right? If you're in your car, look around inside your car. If you're at your home, look around inside your home. Well, there's a wall plate, right? There, where your switch is, your light switch, right? There's a wall plate there. Well, that's not a 30-year depreciable asset. That's a 5-year depreciable asset. Now, how many wall plates are in that house? Now, what about the electrical system? What about the HVAC system? What about the roof? That's a different time frame. And so you could start breaking up that purchase price, and maybe you buy a $300,000 property, and maybe 150 of that is structural. And so you're going to depreciate 150,000 over 20 or 30 years. But you were able to figure out where, maybe 100 or 150,000 of that is 7-year depreciable property or 5-year depreciable property. And so imagine how big your depreciation deductions are going to be in the first several years there. So, you're basically paying no income tax on your rental income for the first couple of years because you've done this cost segregation analysis right off the bat. And again, that's one of those things that a lot of times you just wouldn't necessarily get from that retrospective attitude, right? That's a hey, what can we do right now that we're buying this property that would save us some taxes down the road?
Yeah, this is something we personally do with all of our properties. It's like our investing strategy is actually just completely changed at this point in our lives and our career to focus around the tax side of things. Certainly the accelerated depreciation is a huge benefit that is starting to be phased out over the next few years. And if you're going to do it, you got right now is the time to do it, right?
Yep, get on it.
And just for clarification, I got a few key points, just self-serving questions for you, John, that I'm going to hit you with. I'll wait till later in the show, but I guess, and specifically one of those is my accountant told me, like, hey, we have the short-term rental, which has a different depreciation schedule because it's like hospitality, because it truly is a short-term rental. We have like shorter than 7-day average stays. And he was basically like, you can't take the accelerated depreciation on this year because you bought it in November. And it's like, well, what do I do in the next year? Anyway, we'll get to that later because that's a self-serving question. But just to be clear, for cost segregation studies, do you need to just be a real estate professional status only if you're taking it? Like, do you have to qualify as an RE Pro to begin with to even do the study? Or, I mean, you can still take the accelerated depreciation and still offset passive losses. Like if you have a property that's really cash flowing exceptionally well year 1 or 2, like you can still do accelerated depreciation. Not being RE Pro is still just when you make that translation to offset active taxes, that's when you need to qualify for RE Pro, right?
Correct. Yes, that's exactly right. Yeah, you may, if you're just the casual passive investor, you may have some carryover losses that you can extend off into the future. Whereas, if you're in active real estate, then you're going to be able to offset others, and more benefit there.
Okay, I want to ask you this too, because this is in my mind, this is a risk threshold, and we've never directly talked about this on the show. It's always just been refer to your CPA and your attorney, right? That's a normal disclaimer. But I want to ask you about, and I think this is a risk scenario, a risk benefit scenario that a lot of people, Adam, run through in their minds about like qualifying for RE Pro is. Let's say, I want to ask your opinion both with the CPA and the attorney hat on simultaneously here. Maybe you can separate those out for me, John. But for someone that is considering RE Pro and they think they have a good chance of meeting all the criteria, right? All the things that you necessarily need to do. They have multiple rental properties. They're actively engaged in, management. They own properties in multiple locations. You might call it 5 or 10 properties, whatever. So they're going to look to be RE Pro. How do you advise someone? Obviously, it's on an individual basis, but how do you advise someone on, making that election versus not making that election? And I really want to know about what is the potential consequences here? Like, let's say someone qualifies for or elects RE Pro because it's a self-election. Let's say the IRS comes back a few years later and says they're questioning that, right? Which we've never heard of someone being questioned about it, but that doesn't mean it can't happen. So they get audited, and the IRS says, all right, well, we don't necessarily think that you qualify as RE Pro. Are they just paying the taxes they normally would anyways with possibly some penalties? I mean, is that the risk threshold? Can you talk about that?
Yeah. So I mean, basically with any tax strategy that you're going to take, right? If you're going to take a deduction, and maybe whatever that deduction is, there's a question to it. The general rule is, if you get audited within, and generally from the time you file a tax return, there's a 3-year statute of limitations. So if you don't get audited on whatever you did on that issue, 3 years after you filed that tax return, you're clear. Now, that doesn't apply to outright fraud. Outright fraud has a longer time.
It's proven intentional fraud, right? That's
right. Yeah, that's intentional fraud. Right. That's your Al Capone, and you're not reporting any of your income, and so you're going to go to jail, right? That's a different kind of deal. But if you're just saying, well, I believe that I'm a real estate pro, and so I can take these deductions that wouldn't be available to me as a passive investor. That's fine, as long as you have a 1 in 3 belief that your position is accurate. Then basically what you would owe would be the taxes you would have paid plus interest on the unpaid portion.
What is that interest typically?
There's a federal rate that's set every month, and 4%, it fluctuates.
Roughly, right now.
Well, a couple of months ago it was 1%, right? And now it's back up to 3.5 or 4 or something like that. But
as interest rates are higher, right? Okay.
Right. It fluctuates with the regular interest rates, and so you might owe that plus a little bit of interest, but you can actually then kind of calculate that into your investment decision or your choice of taking that and say, okay, well, if I save X dollars, what's my rate of return on the saved dollar? And if the saved dollar rate of return is going to be greater than the interest on the penalty for that, then hey, maybe it's worth the risk right there. And you say, okay, well, yeah, worst case scenario, I got to pay it back. I've got the liquid capital to pay the back taxes if it comes up. You wouldn't want to be doing that if you're land rich and cash poor, where, you get a big bill from the IRS and you don't have any liquidity to pay it. Well, that's a whole nother deal, right? But yeah, if you can afford to pay the back tax, and maybe, there's a little bit of interest, they will often try to assess some penalties. But again, you can usually challenge the penalties and say, look, I had a good faith belief that was a value, that I had a legitimate position there.
So how does, we got started on the cost segment. Let's just go down that a little bit more. How does that impact your ability to do a 1031 exchange? Kind of on that part, if you accelerate the depreciation, does that impact what you have to do whenever you sell the property?
As well, and that's actually one of the questions on doing whether or not you should do a cost segregation analysis is, what are you going to do when you sell, or if you sell that property, right? Are you going to depreciate as much of this property as you possibly can, with the idea that basically you're going to do 1031 exchanges until you die, so that your heirs get a stepped up in basis and wipe out all of the depreciation that you took, and they could turn around and sell it tax free while the body's still getting cold, right? And if that's one strategy, then it actually probably makes sense to go ahead and do the cost segregation. On the other hand, if you're saying, well, you know what, I'm not even really sure if I'm going to be into this real estate business, this is just a good buy right now, but in a couple of years, I'll probably sell this and just put the money in my pocket. Well, if that's your attitude, then probably doing the cost segregation is not a good idea, because the recapture of that depreciation is going to get taxed higher than the capital gain, and it just may not make sense. You just have to start running some numbers on that. But it often depends on what is your goal. Are you buying to hold? And even if you do need to sell, or if there's a better opportunity, you're going to do 1031s, because you can 1031 and just roll it until you die, and then get that step up in basis, and go on from there.
And I think that really brings us to our next. Sorry, Adam, did you have another thing you want to hit John with?
No, I was going to roll into the generational wealth stuff that he.
No, that's a perfect transition. I just want to hit his previous point home one more time, though, before we do that. But this is a perfect transition to really the bulk of what we want to talk about today with you, John, which is generational wealth, and like what happens. You spend your entire life building this real estate business and portfolio, and sheltering it from Uncle Sam, and of course you want to pass this on to your heirs in the most tax efficient way. And we haven't talked about like how to do that. Most of us aren't thinking about death. Years down the road, we're focusing on right now, how do we build wealth? But before we do that, let me paraphrase you and just tell me if if I have anything wrong here, because this is the way I always think about this in my mind as I explain it to people, giving the disclaimer, I'm not an accountant or attorney, but it's just your initial point about everything tax-wise. There's a lot of black and white, and it is a risk analysis. If you have a good chance of qualifying and justifying real estate professional, it really comes down to a choice. And you're trying to decide, do I file this or not? You always need to understand the back end, like the what if scenario, right? Worst case scenario. Well, why would you not file for that if you have a good faith belief that you would qualify for that, and you've done the research on it? Because the end scenario is you end up paying the taxes anyways that you would have paid in the first place, possibly years down the road. And yes, there could have been interest applied, but it's very likely if you're an investor that you can go out and make higher than 1% to 4%, and have that compound year over year, in actually taking that money instead of paying it to Uncle Sam to actually invest it and compound your real estate portfolio, right? Now, being conscious about the liquidity, and if you have assets, maybe, worst case scenario, again, you can access liquidity by selling an asset or something like that. But I mean, you would want, it's a no-brainer to do that, in my opinion, because if you actually run the numbers out, which I encourage everyone to do, it's not just that, okay, you get penalized potentially, or you get this interest rate of 1% to 4%. But if you take $20,000 or $30,000 that you would have paid the government and never seen again, versus leveraging that on a $100,000 property, and now you're between appreciation, debt reduction, the additional tax benefits of buying that property, which compounds over time, the cash flow, you're talking significantly more than 1 to 4%. Am I crazy in my thinking here?
No, I think you're dead on there. Again, as long as you've got the reasonable a reasonable belief that your position is accurate, I am of the opinion that you take the risk. The chance of getting audited is astronomically low. Even 15 or 20 years ago, when the IRS wasn't an absolute understaffed train wreck, the odds were really low. Right now, it's as close to zero as you can get without having to bring in a physicist. And so, yeah, I mean, take some, push the boundaries, take a little risk. And again, as long as you've kind of run those numbers and again, all the way back to you have a good faith belief, right? You're not trying to, deduct the dollars you're throwing up at a girl on a Saturday night. That's outright fraud. But as you've got a reasonable belief that you can take a deduction, take it. The risk is usually worth it.
Okay, case in point, and we won't belabor that point, but it's all about calculated risks, right? If you want to get ahead, you need to understand risks. You need to take calculated risks. You need to understand how to calculate those, and you need to take them. Ultimately, I think if you want to create, high net worth, and then pass it on to generations, which we're transitioning to now, you got to take some of these calculated risks. That's the game, and you got to be in it. So, but John, let's go ahead and talk about I guess I want to start first with just understanding what. I'm sure you have some fairly wealthy clients that you advise and work with. What are some common things before we get into the details of estate tax and step-up basis and how to, position yourself on the estate planning side? What are some common practices? And this could be in business, this could be specific legally or tax-wise, but what are some common practices of the wealthy people you surround yourself with that you see them consistently doing across the board?
Are you talking about specifically related to taxation type things, or
all the above?
or just
I would say
just kind of all the above, right?
So investing in real estate is probably one of those, but also how are they structuring their real estate? And I don't want to get into the weeds deep of do you need an LLC and how you do that, or are you running your business as an S corp? But what are some general themes? It's just commonalities between the wealthy people, and what are they doing?
Well, and I will say that one of the commonalities, and you're right, I would say, other than my clients who have gotten lucky. And that luck could come in the form of, I've had 3 lottery winners, I've got country music stars, I've got movie stars, and people like that, right? They just got lucky. The folks that have built wealth have either typically done it in some sort of business, though, they've built a manufacturing business from scratch or something like that, and the vast majority of though is real estate. And probably the most universal theme among so many of them is that they actually focused on very little other than continuing to accumulate more real estate.
Can you clarify that though? I mean, that's a basic statement, but I just want to make sure we're hitting that point home, because that was the number one thing that I talked about growing my portfolio. Just state that again, if you don't mind. Yeah. No, I mean,
and I'll just give you an example. I have a farmer right now that I'm doing some estate planning for. He's come to me to do estate planning. He had a will in place. I mean, when a basic will, right? But that was the only real estate planning he had in place. He's got an LLC in place, but it's nothing fancy. It's not a series LLC. It's just right. But he's got $55 million worth of real estate. In this case, it's timber, farmland, but there's some rental properties and things mixed in there. But, for the last probably, call it 75 years of his life, when he had an opportunity to buy more real estate, he bought more real estate. If he had the cash, he paid cash. If he didn't have the cash, or he didn't want to use the cash, he used credit. But whenever there was an opportunity to buy more real estate, he bought more real estate. And you do that over a long enough period of time, and you end up like this guy who's 92 years old and has a $55 million worth of dirt. And so, yeah, he actually probably paid less attention to taxation. He probably paid less attention to structuring and business and asset protection and all of these sort of things. Now, given his age, certainly the death tax and things like that are hitting him right square in the face now. He's facing it. And I certainly would have encouraged him to have these conversations with me many years ago. But I've had a lot of clients like him. They're in the business of real estate. And so when they find opportunities to buy real estate or invest in real estate, they take those opportunities.
And they're probably not hyper focused on, well, what are interest rates right now? What are things? I mean, sure, that's things to be taken into consideration, but really it goes back to the point, like there's no secret sauce here, people. It's just you accumulate wealth over time. It doesn't happen overnight, but it happens over and yes, you want to be intentional on where you're buying and know how to run numbers, and you got to have a strategy and a plan, but you also kind of don't to some degree. Just buy in real estate. It's not overcomplicated. Just keep doing it, right?
Yeah.
And
I had another client, and one of the things he said to me, and it's always kind of stuck with me. We were talking about his estate planning, and he said, John, I have lost more money than most people will ever make in a lifetime, but I've made more money than I've lost.
I love it.
Right. And I mean, I think you kind of have to think about that, yeah, okay. Hey, this looks like a good deal. I'm going to go for it. And you know what, maybe I lose out on this one, but that's all right, because there's going to be more, there's going to be other opportunities, and I'm going to lose some, and I'm just going to try to win more than I lose. And I do that long enough. And there you go.
Yeah. I had the same thing happen just a couple weeks ago, buying some property, and I started freaking out, and my wife was like, what's going on? And I was like, well, we're doing this, and what happens if it goes wrong? And she's like, well, you did the research, right? Yeah. You did this, right? Yeah. So we're going in knowing worst case scenario is this, right? Yeah. Okay. We can handle that. Let's do it. Right. But I want to go into a little bit. You mentioned that you wish this guy had come to you several decades before. We have a lot of people who are just getting their first, second, third real estate properties there. They probably had a will, maybe they have some younger kids. They probably had a will made up whenever their kid was born before they owned real estate. If you've got something, just a simple will set up there, and then you start buying real estate, what are some of the next steps that you recommend people consider doing in order to protect themselves, their heirs, all of that? Kind of what's the simple steps you can do as you're getting started?
So on a very simple standpoint, one of the first things, particularly with things like rental properties where you have ongoing active management, maybe you're not the one doing the management, maybe you've got a company that's doing the management, but these things require management, right? Somebody has to collect rents, somebody has to pay expenses, somebody has to fix water heaters, and maybe you're not the one doing that, but somebody's got to do it, or somebody's got to direct other people to do it. Which means you don't have a lot of opportunity for delay, right? So if I do a will, right, and I do a will and I say I leave everything to my kids, in any state in the United States, no will is valid until it has been admitted to a court after my death. Now, if you're in a rural community, maybe you get that process done in 3 to 4 weeks. If you're in a major metropolitan area, Boston, New York, Los Angeles, Dallas, Texas, it may be 6 months before you even get the will admitted to probate and the executor appointed. I mean, can those real estate properties, can they go 6 months without management? Between the time of your death and the time somebody is able to weasel their way through the court system to get appointed as the executor in charge of your estate? No, absolutely not. You need to be focusing on non-probate transfers of assets so that the minute you die, somebody is in charge. Somebody can take over, whether that's somebody you appoint or a bank or whoever you've got in position, but you need to be looking at non-probate transfers of assets at death, period. There's just almost no good reason to use will-based planning in this day and age. There are better alternatives.
Can we, and these are like the little nuanced things that I think most people are probably, myself included, like really aren't aware of. Maybe we've created a will, maybe not, or maybe we just haven't gone through now that we're on the path of creating a larger wealth scenario where we need to be conscious of these types of things. I mean, can you just give us an idea of like, what's certain things? Obviously, people can reach out to you or, whoever they're working with to have a consultation, like start setting some of these things up. But just for awareness, like what are some things we do need to be aware of from a taxation and a logistical standpoint like this as we near death and look at in the most tax efficient way, passing on our wealth to future generations?
Right. So I would generally tell, I give speeches on this sort of stuff, and I say there's 3 elements to a good estate plan. Element number 1 is having a plan for incapacity. That's, if you live to age 80, the chances of you being incapacitated prior to death are 90%. And maybe for a short period of time, but we're back to the question of if you're talking about properties that need management and stuff like that, what length of time can you go without those being managed? And so you need a plan for incapacity. You need a smooth and easy and tax efficient transfer at death. And we can talk about this, but you need to be looking at the estate tax versus step up in basis. And we can get into some of that. But we also need to be looking at things like retirement accounts. If you're doing, if you've got the bulk of your net worth in an IRA or a 401k, especially if you're talking about having real property inside those, a self-directed IRA or something like that, there are some significant tax consequences when those qualified accounts are inherited. And so we need to be looking at all of those issues surrounding death, making it transition fast and cost effective from a tax standpoint and otherwise. And then we need to be looking at protecting the beneficiaries, whether that's from themselves or whether that's from outsiders. With kids, for example, I always talk about what I call the 4 Ds. Your children could die, they could predecease you. They could become disabled, in which case they're on government benefits, which you just cause them to lose if they inherit an asset. They could be in debt. They could have their own creditors, unpaid child support, or behind on taxes, or whatever that is. Or you want to leave assets to your daughter, but her husband just ran off with a stripper named Cinnamon. You don't want the inherited assets getting tied up in the divorce of the child. So it's kind of these 3 parts: your own incapacity, the transition at death, and then the protecting the beneficiaries. So those are the 3 elements of a good estate plan.
Yeah, a lot of time, and that's a difficult thing to think about that maybe we don't want to, but protecting the beneficiary, right? I mean, you do need to have those things set up in place. It's hard to say all the potential out there, but certainly we're all working very hard to build a lifestyle and a scenario where we can take care of our beneficiaries for many years, and obviously create generational wealth is a goal. So we have to protect it appropriately.
And one of probably the most common question that I get from people is related to the death tax. They don't understand it. They've heard it talked about on the news. They hear politicians going back and forth with, we need to make more people subject to the death tax. We need to make less people subject to the death tax. So we need to get rid of the death tax altogether. And yet most people don't really have any concept of it. They don't know what they're talking about. They're scared about it, but in many cases have very little to worry about. Just as real brief history, prior to 1916, there was no inheritance tax. It came out in 1916. And in 1916, if the value of your estate was greater than $10,000, you were taxed at 90%. Now, $10,000 was a lot of money back then, but not if your last name was Rockefeller. And so what rich people like Rockefeller did is they started giving money away. They said, well, if you're going to tax me when I die, I'll give it all away before I die. And they got away with that until the mid 1920s, I think 1924, when they created the gift tax. And they said, okay, if you die holding a certain amount of money over that, we're going to tax you. Or if you try to give it away while you're alive, then we're also going to tax you. And those two are kind of tied together. So you can't understand the death tax without understanding the gift tax, because they're one and the same. They're tied together. And the funny thing is right after that, people like Rockefeller or Carnegie or whoever, they got the idea, well, if you're going to tax me when I die, and then I'm going to leave everything to my son, and then when my son dies, you're going to tax him again, right? Because he's still be over the limit. Well, I'll tell you what, I'm just going to skip my son, and I'm going to go to grow my grandson, or maybe my great-grandson. And that way I can skip a couple of generations of that death tax. And they got away with that until I think about 1936, at which point they created the generation skipping transfer tax, which is a whole separate tax that says if you try to skip a generation, then they're going to hit you there. And so all of these things, they've been around forever now, and, we're 100 years of this sort of stuff. As we sit here today, a person would have to have an estate valued at roughly $12.93 million before they have to worry about the death tax. So I've got lots of folks. They'll come in, John, we're worried. We don't want to have to pay the government anything when we die. And I say, okay, well, what do you got? Well, we got a house, we got a couple of rental properties. Total estate's worth $3 million. Okay, well, you're fine. You're not anywhere close to $12.9 million. Now, if you cross that $12.9 million tax, it's effectively 40% of everything above that. So, I mentioned my gentleman earlier, we're just say a $50 million estate. Well, if we subtract 13 off of that, we're still looking at a $35 million estate. You tax that at 40%. That's a fat tax bill after his death. And if all of that net worth is tied up in real estate, where are you going to come up with the cash? The IRS expects that check within 9 months of the date of death.
They don't take land in payment.
And they don't take land in payment. And so, the family's stuck there in a position where, what are they going to do? Are they going to take out loans against the real estate to pay off taxes? Or are they going to have to, fire sale some of the dirt? Or are they going to have to cut timber before it's ready to be cut? I mean, that's a real danger when you're heavily invested in illiquid properties, especially when it comes to a big fat tax bill. So that's the marker right now. But the weird thing is we're in a very unique time right now, because the current estate tax exemption amount was set in under the Trump administration. It was part of the Tax Cuts and Jobs Act. And in order to make the budget work, they built in an expiration date. And so that law expires on January 1st of 2026. And if it expires, which who knows, we can't predict the government, but if it expires on January 1st, 2026, then the law reverts back to what it was under the Obama administration. Well, that was a $5 million exemption. And then that'll be adjusted for inflation, probably putting it at around 6, maybe 7, depending on inflation numbers over the next couple of years. But, imagine you're somebody right now and you have a $7 million estate. Well, you don't have an estate tax problem today. You might in 3 years. Yeah. That's hard to plan for.
So when you've got that, a two-part question. You've got the guy, $55 million. Kids might get hit with, roughly a $10 million hit on their for the death tax there. What do you put it in? Like, is that kind of what are you putting that in to make sure they don't get hit with it? And then also on the flip side, if you've got an elderly parent who owns real estate and they don't have anything set up, is there anything you can do as a child? If they're slightly incapacitated, is there anything you can do as a child at that point in time to prepare yourself?
John, let me jump in and get clarity on a couple of things. Obviously, getting to the bulk of Adam's questions is exactly what we want to know. Is like, okay, well, what do you do, right? There's an oh crap scenario, and then what are our options? Talk about step up and things like this. But I want to just clarify for everyone, because 12.5 million or whatever, and even 5 million may seem far-fetched to some people, but it's really not. especially as we're talking about, like, it may seem that way if you're buying your first 1 or 2 rentals, but you can get there very, very quickly over a course of a few years, just owning rentals in appreciation-based markets. But when you're looking at, let's say, the $5 million, mark, the death tax, is that based on like total? Does leverage count into that at all? Like, is it net worth, or is it like I own $5 million of real estate that I leveraged, and it's based on $5 million?
Yeah. So your gross estate does factor in the debt associated with properties. So if you have a $5 million property, but your mortgage is $4 million, then that's $1 million to your gross estate for tax purposes. So they do take that into account, but they also included in the value of your gross estate is the death benefit of life insurance.
So clarify how that works again, because this is something we personally do as well. And like at least how we built our policy out, there should be a very, very large payout at death, assuming I live, past 60 or whatever.
Yeah. So let's say that I'm a hobo, right? Just a good old fashioned riding the rails hobo. I don't own a thing in the world, but somehow I am able to afford a $15 million term life insurance policy, right? So term life, no cash value to me whatsoever. But when I die, my heirs get $15 million. The value of my taxable estate for death tax purposes is $15 million. So, you take something like, we use the example, okay, I buy a piece of property for $5 million. I take a $4 million loan out to purchase it. But let's say that I have some sort of credit life, right? So that's going to pay off that balance if I die. And so my kids get a full $5 million paid off property. Well, then now, because of the life insurance component, my taxable estate is $5 million because they're going to include the value of the life insurance in my taxable estate.
What about people that have whole life where there's the death benefit is paid, tax free? Yeah.
So it's income tax free to the beneficiaries, the death benefit. But that same dollar figure is added to your gross estate for death tax purposes.
Okay. All right. Well, let's get to the juice of it. What options do we have to strategically navigate this?
So there's obviously a lot of different options that we certainly couldn't cover the whole world. But let me just give you an example for like this one that we were talking about. So let me ask you a question. Let's say that I have a property. House, let's say, and we've had it appraised, and it appraises at $300,000. Okay, so we're all in agreement that the property is worth $300,000. And so, Zach, I'm going to sell you this property. I want to sell it. You want to buy it. Okay, but once I sell it to you, even after I sell it to you, I retain the rights to determine what paint goes on the walls, what furniture is placed inside this house, what the thermostat is set on, what tile goes in the kitchen. All right.
Sounds like a great deal for Zach.
All right. So we're all in agreement that the house itself is worth $300,000. But how much would you pay for this with these restrictions on it? Probably not $300,000, right? I mean, you'd pay something. It certainly has value, but you probably wouldn't pay the full fair market value. There would be some restrictions. You would have to say, well, look, if I can't decide what paint color and what floor tile and what furniture goes in it, maybe I give you $200,000.
I guess it depends on who you are in relation to me, right? And
certainly. And then what if I said, okay, yes, I'm going to sell it to you, but if you ever want to sell it, you can only sell it to another member of your family. You could never sell it to a third party. Well, all of a sudden that's going to change the value too, because if you're thinking, well, yeah, okay, I'm going to buy it at 300, but I'm buying this asset that's going to grow in value, and maybe I want to cash in on that at some point. But if I've got restrictions on who I can ever transfer it to, well, then once again, I'm not going to pay, say, fair market value for that. I'm going to pay something less. Okay. So keeping that whole concept in mind, let's say, let's take this gentleman and let's say that I create a limited partnership. Now, a limited partnership is going to be made up of a general partner who has all the control, and limited partners who have no decision-making authority whatsoever. Now, they're the owners, right? So the general partner typically owns nothing or very little, 0 or 1% or a 0.1% or something, but they own basically nothing. The limited partners now own everything. So let's say I create this limited partnership and I own 50% of the limited partners, and then each of you two guys own 25% of the limited partnership interest, right? And I put $1 million worth of real estate, fair market value, $1 million worth of real estate into this limited partnership. Okay. What's the value of my 50% limited partnership interest? If we had to walk out onto the street and find a willing buyer to say, hey, would you like to buy John's 50%? Well, 50% of $1 million is 500,000, right? Except that limited partnership, if you buy it, you can never demand a distribution. You can't make any investment decisions related to the limited partnership. You can't vote on anything. All of that is done by the general partner. You're not buying that. You're just buying this limited partnership interest. And if you do buy the limited partnership agreement says that it can only be transferred to certain members of a family. And so if you ever want to sell it, you've got restrictions there. So all of a sudden, if we were to go and get a business appraisal and say, what is the appraised value of John's 50% of this limited partnership interest? Well, we're going to take a discount for lack of marketability because it can't easily be sold on the open market with all these restrictions.
I'm going to say if it limits it to family, it's 0, right? To the business.
Right. Yeah. I mean, so we've got a lack of marketability, and we have a discount for lack of control because you're buying into a business that you can't make any decisions about. So we have a lack of marketability, we have a lack of control, and maybe the business valuation comes back and says, okay, well, John, you're $500,000 worth of limited partnership interest, we need to discount that by 30%. Right? Okay. Well, or maybe even just 20%. We say we discount it by 20%. Well, we just cut a big chunk off of that. If you start adding more zeros to that number, right? If we say instead of if I put in, if I, not 1 million, but, 50 million. Right. And then we say, okay, well, then let's discount that 50 million for lack of marketability and lack of control. And let's discount that by, say, 30%. Well, if we cut, $15 million off of that, so now my taxable estate, the fair market value of what I own, and what I own is limited partnership interest. The fair market value is not 50 million, it's 35 million. 40% of that extra $15 million was a lot of money, right? So I mean, right then, just bam, I'm able to make some significant discounts on the valuation. So, that's just an example of the kind of strategy that might be available for somebody that's on that high end of things.
So that's putting in a portfolio, basically turning it over control to. And we didn't talk about like who these working parts are, but basically you're taking an LP position on your portfolio and getting a discounted rate because of that, right, on the value.
Right. Although you might still be in a position within the general partner to manage those assets. Right. So I'm transferring my assets into this family limited partnership. I'm going to maybe control the general partner, or depending on my age, maybe I want to bring in some of the kids and create some kind of co-management to get them working in the business, and so they can start learning how it's going as well. But the ownership of it is essentially going to be these limited partnership interests where we get the discounted valuations.
What else can we do? I mean, because that knocks off 15 million in that scenario, which is great, but I mean, it's kind of my understanding that there's more options that can even be potentially more effective too, right? Can we talk about also like what is step up basis? How does that work?
Yes.
So we need to get deep into the weeds. I know we could talk about this all day long. We'll probably have to have you back, John, to do a deeper dive into some of these things, but it'd be good to just get like a teaser on some of them just for awareness.
Well, and so just using that as an example, but now let's flip this over to Adam's other question. It's okay. So I've got my parents over here, right? And these are not $12 million folks. So that whole discussion was irrelevant to me. This is, it's mom and dad, and they've got a house, and let's just say they've got a couple of little rental properties. They've had them for a long time, so they've just depreciated them all down. And their house they bought in 1952 for $25,000, and it's worth $300,000 now. The inheritance, when they die and I inherit their assets, inherited assets come generally income tax free. So I'm not worried about the income tax coming to me, but I'm not going to, I don't want their house. And so when they die and they leave me their house, I'm going to want to be able to sell that house. And so my question is, well, how much tax would I have to pay on the sale of that house? Well, generally speaking, if you own an asset at your death, and you transfer that asset as a result of your death to your family members, it's as if the family members went out and paid fair market value on the date of death. So although mom paid $25,000 for it, it's worth $300,000. She dies, I inherit it. It's as if I paid $300,000 for it. If I turn around and sell it the next day for $300,000, well then sales price minus my basis is zero. I pay no tax. That's the step up in basis. And preserving that in that scenario is much more important than worrying about a death tax, because these folks aren't ever coming to the death tax. They're never going to have $12 million. On the other hand, if my mom has Alzheimer's and she's going to need $6,000 a month in long-term care, having these extra properties may be a bigger problem because she can't qualify for government assistance. You're not going to qualify for Medicaid and have two rental properties. But maybe if I would have shielded those assets with a trust, so that my mom still gets all the rental income from it so she can use it for her quality of life, but the assets don't count towards her eligibility for Medicaid. Well, now I'm solving her incapacity problem, right? Now she's going to be able to get the government to pay for her care without having to burn through their net worth. But now it begs the question, if the assets are in a trust and I'm not inheriting them from mom anymore, I'm inheriting them from a trust. And the trust didn't die. And so do I get this step up in basis? And if the trust is structured correctly, yes. And so this is where a lot of these things start interplaying. I want to be, if you're talking about somebody that's, say, under the death tax, you're going to be more focused on preserving step up in basis. If you're above the death tax, you're going to be more concerned about avoiding that 40% death tax. And so trying to find the balance between those two things and where you're at and where you are in your stage. If you're just starting out, you're going to be more concerned about step up in basis. If you've been doing this for a while and you're now starting to amass some wealth, your focus will start to shift to that death tax, and that'll become more important than preserving the step up in basis.
Is there anything else just offhand that you can do to, shelter the 40% beyond, doing the P.L.L.C scenario?
Yeah. So I will say, the vast majority of my clients are not in that $55 million range, right? I have those, but more often I'm going to see folks with, maybe they've got a 2 million, 3 million, maybe a 6, maybe a 5, maybe an 8, maybe a $10 million net worth. So they're in that middle range, right? 1 to 10. But their goal is to grow. Their goal is to get bigger and bigger. And they certainly would hope that over time those assets would get bigger. So I mentioned that these things, that the death tax and the gift tax are tied together. People will often ask me, well, John, I heard I can only give away $17,000 each year without having to worry about the gift tax. Well, that's true. That's the annual exclusion. But in addition to the annual exclusion, I could give away up to $12.9 million during my lifetime. Now, if I did that, if I gave the whole $12.93 million away, I don't have any death tax exemption left, right? If I use up one during my life, I'm using up the other one, right? But let's just say that I've got a net worth of $7 million. So I don't have a problem today, but I will have a problem in 2026. Well, now I could have a couple of options. If I'm married, for example, I could create a trust for the benefit of my wife. And I could put my $7 million worth of assets into that trust. I can make a gift to my wife of $7 million. The trust is structured so that it's not part of her estate when she dies. And since I've given it away, it's not part of my estate when I die. And then over time, maybe that trust grows from 7 million to 14 million or 22 million or whatever. It doesn't matter. I got it out of the tax system while it was low. No. And yeah, I used up a little bit of my exemption amount, but who cares, right? It was much more important for me to get it out while it was low and then not have to worry about it once it got big. As opposed to like this other guy where it's already big and now we're kind of solving the problem, but not really. I mean, we're helping, we're slowing the bleeding, right? But if I'd have gotten to him, say, a few decades ago, we might have done something like that. You can also even create a trust for your own benefit that is excluded from the death tax when you die. So I could transfer assets to a trust that I'm a beneficiary of, but they're not mine for death tax purposes any longer. And that sounds crazy.
Gotta love our tax system.
Yeah, that sounds absolutely crazy. And the funny thing is there's only I think there's 21 states in the United States that you could do that in. So you would have to be creating a trust under the laws of one of those 21 states. But for example, I practice in Texas and Arkansas. Texas is not one of those states. Arkansas is one of those states. But Arkansas just became one this last legislative session. I drafted their bill. But prior to that, we would use Nevada, because Nevada was one of those states. So is South Dakota and Alaska.
I'm sure Wyoming's probably.
Wyoming as well. But that's kind of the cool thing is you could be a Texas resident and create a trust that's governed under the laws of Nevada. Or one that's governed under the laws of South Dakota. And so you can turn around and take advantage of the tax systems of other states if the planning is done correctly.
So is the death tax based on your portfolio or how much you're giving each child? Because let's say, I run up a $20 million estate. I die. I've got 4 kids. They're each going to get $5 million, let's say. Is it based off of what I own or what they receive?
Yeah, it's based on what you own. So when you look at the estate tax return, which is this Form 706, and I mean it just goes schedule after schedule. List all the real estate the person owned. List every bank account they owned. List every stock that they owned. List every mutual fund they owned. List the death benefit of all their life insurance. I mean it's just page after page of list everything that dead person either owned directly or in some cases didn't even own but had certain level of control over. And so it's quite complicated, but yeah, you can pretty much assume that when it comes to the death tax, they're going to try to add as much to that gross estate as they can come up with.
Yeah, that makes sense. That way you're not just adding a ton of different beneficiaries and carving it up as easily as you can. But John, I'm mentally exhausted now. But
as you should be.
This is important stuff to talk about that like I said, we probably haven't done. I mean, certainly we want to have you back and do a deeper dive into some of these things. But the key point is here, this is things to possibly think about. And people are at different stages in their business and their real estate investing. And at some point, if you stay the course, to our earlier point in this conversation, if you just stay consistent to buying real estate year after year, these are things that you're going to need to think about. And so it'd probably, be to your benefit to have these discussions earlier rather than later to get ahead of the curve and solve, have a plan for these issues. So, but if you're not at that point yet, just awareness is important, and the idea of continually buying your portfolio to eventually have these problems, which are good problems to have ultimately, I think is the focus here. Let me just ask you, because I know we're just coming up. Well, go ahead and let's do a showcase to where people can find out more about you.
Yeah, so you can find out more about John and his team at rossandscholmire.com. That's rossandscholmire.com. If you're a lover of podcasts, he also hosts the Big Picture Retirement Podcast, which you can check out. Just go to your podcast platform and type in Big Picture Retirement Podcast, and I'm sure you'll be able to find it on that platform. But yeah, so Zach, you had one last question?
Yeah, and people can feel free to tune out, but I do know that this is probably of interest to some people as well. I have a large portfolio of multiple different asset classes, probably the bulk in commercial retail, but I also have a good portion of short-term rentals. We acquired one last year in November, and my CPA determined we've already filed taxes, so it's a little late now. But I want to revisit this, and I just wasn't given clear direction on it. As far as we had a short-term rental that we did accelerated depreciation on, that we do all of them on. But I was told that since it was acquired in the last year in November, end of November, that we wouldn't qualify to we weren't able to dedicate on a short-term rental. You need to have, I forget 500 hours of material participation or something like this to actually take the accelerated depreciation against active income we're reporting a significant loss every single year. So this is just furthering that loss. But the question is all right, you count it for the year that it goes into, into activity, right? You take ownership of it, but it just didn't sit with me. I'm thinking well, there's got to be something I'm missing here. If I bought the property in November, sure, I'm not going to be able to calculate 500 hours or whatever that year because I only owned it for 1 month. But what is your opinion on that? And could we have taken it that year? What can we do this year with that property now that we would have owned it and operated it for a full year? Any ideas on that?
Yeah, there's several examples of similar things throughout the tax code that don't make a whole lot of sense, where there's some sort of holding period requirement, whether it's a number of hours or some sort of use or something, where if you purchase it at the end of the year, it just doesn't work. Where if you were a manufacturing facility and you bought a brand new piece of machinery on December 31st, you could take accelerated depreciation on the whole amount, because there's no arbitrary time usage according to that piece of equipment. So basically, you're just the short answer is buy sooner.
So you would say that my CPA was probably correct in stating that was not appropriate to take that.
That is my understanding is that if when it's got those kind of arbitrary, it has to have X number of hours of use, or it has to have X number of days of use for you to take the accelerated depreciation. It's not one of those where you can create some sort of fractional formula or something and say, well, we could take 1/12 of it because we bought it at the end of the year, like you could with other assets that don't have that arbitrary use number on it.
What about this year, though? With now that we would have owned it for an entire year, but we did the cost seg study in 2022. We've now, when we filed 2023 taxes, we would have owned it for a full year, but we already took accelerated depreciation as a passive loss last year or in 2022. Is there anything we can do to roll that back over? And if I know I'm throwing this at you without any additional information, so feel free to decline. But is there anything we can do this year to use that as an active property now? Do I go and get another study done, or do I have to amend the previous taxes? I'm just kind of curious on that.
You wouldn't have to go back and amend, but now I am stretching my just off the cuff recall knowledge. It seems as if, because I just looked at this for another client here recently, but there's something about if for example you didn't take the cost segregation analysis the at first, but you're a couple of years into it, right? So somebody that bought a property, say 3 years ago, and they're just now listening to this show, and it's the first time they've ever heard the phrase cost segregation analysis. There is a way that you can go back there. You have to make like an election to change accounting method with the IRS, if I'm remembering correctly. So there may still be a way in there, but I just don't remember it off the top of my head.
Fair enough, John. I've thoroughly quizzed you on a lot of stuff, and I know your forte is certainly the estate planning aspect of things as well. And this is probably how it goes if people just ask you 1,000 questions about all things accounting.
Absolutely.
But, and you were correct. I do know that people that have owned properties previously, if you haven't taken accelerated depreciation, you still can.
Right.
And that's important to know, especially this year, as we are now at 80% bonus depreciation. Next year it goes to 60. So if you're now getting into this, like we talked about, into this area where you might qualify as RE Pro, and you own rental real estate and you're paying money to Uncle Sam that you otherwise could invest, this is the time to probably start considering that, at least doing further research on it. But John, this has been a pleasure. Thank you so much for all the detailed information. I'll let Adam sign us off here.
Yeah, anytime y'all want me, I'm here.
All right. So once again, the website is rossandscholmire.com. That's rossandscholmire.com. If you want to see some assets that you can acquire to hit that death tax limit that we're all aiming for, you can head on over to renttoretirement.com. That's renttoretirement.com. Really appreciate the time you spend educating yourselves. Don't forget to leave a review on whatever podcast platform you use. Just search for the just get on there, take a screenshot in the next few days, and we will enter you into a raffle. But again, that's at renttoretirement.com. Appreciate the time you spent educating yourself, and we'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.